The U.S. retail real estate market continued to recover at a steady pace during the second quarter of 2014, closely tracking the gradual improvement in retail sales that we've seen over the past 5 months. Demand for retail space remained solid, with the U.S. posting nearly 8 million square feet of positive net absorption in neighborhood, community, and strip centers nationwide. As a result, the national availability rate dropped for the third consecutive quarter. This improvement was widespread, with about 70% of the markets tracked by CBRE reporting declines in availability during the quarter. Rental rates also continued to inch up, a welcome sign for a market that posted 5 years of declining rents between 2008 and 2013. Construction activity remained at historically low levels, with only 2.5 million square feet completed, and the lack of new supply is forcing retailers to lease space within existing properties, which is obviously encouraging overall market fundamentals. U.S. retailers got off to a rough start in 2014, as many U.S. consumers understandably chose to stay at home rather than endure the extreme winter conditions. Since then, we've seen slow but steady growth in total retail sales. As of June, retail sales were up 4.3% on a year-over-year basis, an improvement over what we saw at the beginning of the year. Sales activity at electronic and appliance stores has improved in 5 of the last 6 months. Purchases at general merchandise stores were up 14.5% in June, and food and beverage stores were also up as well commensurately. With sales slightly stronger, job growth strengthening, and most economists expressing optimism about the direction of the U.S. economy, we expect that retailers will continue with their open to buys in the coming month, but will do so cautiously. Investor appetite for U.S. retail assets continued to grow during the second quarter. Cap rates for retail properties are hovering right around 7% nationally when you look at all different types of formats. There are 2 trends that are really driving this shift. First, return on investment grade retail properties have been stronger compared to returns on office, industrial, and multifamily investments. This has attracted investors seeking higher yields. And second, the 10-year Treasury yield has gradually and unexpectedly been falling during the first half of the year, placing downward pressure on interest rates. And with the interest rates expecting to rise slowly in the coming months, investors saw the first half of the year as an opportunity to lock in relatively low interest rates when acquiring or refinancing assets, which is stimulating transaction activity overall.